please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Thank you for joining us on Taking Stock, the show where we take stock of the week gone by and prepare you for the one that's about to come next. I'm Surabhi Upadhyay and with me is Ekta Batra. Hi Ekta, interesting week for the market. The net result was it seems to be bulls in control.
Yes, well, Surabhi, it turned out to be a fabulous week. In fact, we had the Bank Nifty, which really outperformed this week. We had the Bank Nifty, which was up almost around 2% and we had a lot of stocks which rallied. We had Axis Bank, which rallied on Friday with a gain of 9% Yes Bank the day before that also did that kind of momentum, and for the entire week, in fact, Yes Bank was up around 13%. So a lot from the IT space, a lot from the banking space.
I think the takeaway for the market this week was that it's really earnings trumping all kinds of macro concerns, and we've seen that play out not just here for us at home, but also on Wall Street, because we've had this whole story of, high oil prices, the US 10-year yield touching 3%. But whenever earnings have come out on top, stocks have rallied, and that's exactly the theme that played out here in India as well. So as Ekta highlighted, a lot of these stocks where perhaps the disappointment in Axis's case, you could argue, was already factored in. Those stocks really rallied quite smartly. The other big event of the week was, of course, TCS hitting $100 billion in revenue. After that, there was a cool-off in tech stocks, but otherwise, it's been good. The macro concern for India was the rupee as well, and that is a watch point, a bit of a worry factor, because we've been flirting around those levels of 14-month lows. Well, those were the concerns, but the bulls did manage to surmount all of it, and the Nifty taking aim at 10,700 now.
Yes, in fact, TCS joining the $100 billion market cap club, and not to mention that the US 10-year, like you mentioned, was above 3%, the first time that we've seen all the way since 2014. So an eventful week to talk about over the next 30 minutes, and joining us on the show to discuss this week on Dalal Street is Ambit Capital's Pramod Guppy. And Pramod, hi, welcome to the show today. Well, let's start with what actually made news towards the end of the week, the banking space. We had Yes Bank as well as Axis Bank, both rallying post numbers. Your sense in terms of whether maybe the worst could be over for private banks and especially maybe corporate lenders?
Yeah, I think banking stocks should generally do well at a time when cost of capital is going up, particularly those with a strong liability franchise. So it's no surprise, but of course some of the corporate lenders were being dragged down by asset quality issues, and given the sort of commentary we've seen coming, it might suggest that perhaps the worst is behind us. So the private sector corporate lenders, perhaps we are closer to that end, and going forward, given that they have a strong retail liability franchise, and if much of the credit cost goes out of the P&L, you're looking for significant earnings pickup as the year goes by. However, the PSU banks have more of a structural issue in terms of governance and so on, which is where I don't expect a significant rally, or at least this sort of a rally sustaining, beyond the next 3 to 6 months.
Interesting, Pramod, you say that. Good talking to you. I want to extend the conversation to NBFCs, because while there's a debate raging about the kind of earnings that we've seen from some of these private sector lenders, NBFCs, largely speaking, whether it was Shriram, M&M Financial Services, Chola Mandalam, at least the numbers look pretty good. How would you approach the space now?
Yeah, I guess within the broader NBFC space, vehicle financiers are our preferred pick as well. So all the three names that you mentioned sort of tick the box there. There is an element of pickup in underlying OEM sales. At the same time, penetration is also playing. And most of these NBFCs did have a relatively benign liability profile, in the sense their exposure to the bond markets and hence increased cost of funding is not as much of a concern. And also their asset side is more fixed, and that tends to get repriced far more quickly, and hence the impact of the higher cost of funds is not meaningful here, as opposed to something like the housing finance sector, which is more into floating rate assets. So that can be a bit of an issue. So in my view, I think the auto financier NBFCs are in a relatively good space to be in, both from the asset and the liability side.
Well, Pramod, just Your sense on the Nifty now, because now we're almost at 10,700, but we do have a May series which is going to be dominated by one, the Karnataka elections, and two, what's going to happen with the remaining set of earnings as well. What's your sense in terms of where we could head?
I think earnings will drive stocks on a selective basis, and often we find that the first half of the earnings season is the better sort as far as earnings numbers are concerned. So we're not surprised by the positivity so far, and as we head towards well into May, we can expect this sort of a buoyancy to sort of moderate. But overall, I think once the earnings season is done, the macros will take over, which isn't particularly pretty, both in terms of the local catalysts as well as the global catalysts. Particularly with where U.S. Treasuries are, I think asset allocators globally will be taking a closer look at how much of exposure they need for risk assets, including emerging market equities. And as the sort of dust settles, with U.S. Treasuries remaining north of 3%, we might see the impact of that playing on the markets in terms of some sort of pullback of assets away from emerging market equities, of which India I don't think will be immune to entirely. So it'll be a combination of bottom-up earnings-driven results until perhaps middle of May, and then we'll have the macros take over again.
Interesting. So that means limited upside to the market, at least this semi-breakout of sorts that we've seen on Friday?
Yeah, certainly at the index level. I guess 2018 will remain a year of bottom-up stories rather than at the macro level. There are far too many risks, far too many uncertainties, starting with liquidity, which is the biggest uncertainty as to how the Fed roll-off pans out as we go through the year, and also how the ECB takes it. We're pretty much in the middle of it, where they have to take that call as to extend the QE or sort of take a big pause. And especially with the Fed rolling off, you might see that liquidity going off, adding to the pressures created by asset allocation, or asset reallocation rather, back into U.S. Treasuries. So I don't think the macros will provide the tailwind for the market at the index level. But having said that, given the micros are looking good, there will be opportunities to make money from a bottom-up perspective.
Okay. Which are the sectors that you think will provide this maximum opportunity from a micro perspective?
I think financials, like we discussed, particularly the private sector financials, both the banks and the NBFCs will certainly be a good bet at a time when cost of capital goes up. You'll see margins expanding, or at least some of these lenders becoming more competitive against their far less competition, and should be able to see a combination of both loan book growth and margin expansion driving earnings growth. So that's one sector certainly worth looking out for. Again, given where US Treasuries are and how the dollar is behaving, IT certainly ticks a lot of boxes. We've seen the macro play in its favor in the form of IT spending picking up, and alongside the sort of investments that IT companies have made through the last 3-4 years in digital technologies should mean that they regain their competitiveness, and that adds to it. Alongside that, if you get a tailwind in the form of a rupee depreciating against the dollar, that's one sector which should support earnings growth as we proceed. And finally, I think consumers shouldn't be ignored in a year where there are a plethora of elections running up to the general elections, both in terms of election spending by political parties as well as the sort of rural focus that the government has had. You will see some pickup in terms of consumer spending, and that should be another area of focus in my view.
You mentioned IT, Pramod. What would you rather stick with? Large cap names like the TCS, HCL Techs of the world, or mid-cap IT? Because there's been a phenomenal rally with stocks at lifetime highs there.
Yeah, I think perhaps the valuation gaps between the mid-caps and large caps have sort of played out in the sense it's about time that the large caps take the baton in terms of leading the rally here. But having said that, you must remember that these are quite structural changes in the way IT services are consumed by the Western world, and it's much easier for a mid-cap company to change track, and which was in fact demonstrated by their early pickup in earnings, as opposed to the large caps who find it harder to maneuver. But now that the valuation gaps are sort of doesn't leave much on the table in terms of the mid-cap catch-up, I would think the large cap should take the baton in terms of driving IT returns.
What's your sense, Pramod, on what's happening with consumption? There is a lot of interest which is coming into these urban consumption as well as rural consumption plays. Your sense?
Yeah, I think consumption will have a double whammy in the sense both on the demand and the supply side should see some sort of tailwinds. I talked about the demand side in terms of the spending by the political parties and some sort of rural distress alleviating, partly because hopefully we'll have another normal monsoon, but also the sort of developmental agenda that the government has put in place. But more importantly, I think the supply shocks that consumption had in the form of demonetization, GST, are abating quite significantly, and that should mean that the channels are back in place, and the sort of product pipeline some of these consumer companies have put in place should start showing up in both volume growth as well as price realizations. To that extent, I think consumption should be entering a good 12 to 18 months.
Finally, Pramod, politics is always exciting in this country. We're running into another state election. Do you think Karnataka is material for the market, or is it going to be just a 1-2 day phenomena? And then we get back to macros and earnings, as we've already discussed.
Yeah, I would tend to think that this is more like a short-term phenomenon. We've seen these in the past, if at all, on the back of these election results. You see some sort of a sell-off. We see that only as an opportunity to buy into some of the bottom-up ideas that we prefer. I don't think the market will look at it on an extended basis, unless the message coming out from the electorate is quite catastrophic in the sense political stability will be questioned. I don't think Karnataka elections will point in that direction.
Okay. All right, Pramod, great talking to you. Thank you very much for being with us on the show today. Well, on that note, we have to take a quick break. But before we do that, we will leave you with some more market opinion that we gathered during the course of the week. When we come back, technical talk. Sudarshan Sakhani is going to be joining in with a technical perspective on the index and, of course, stock trades, as well as some of your questions coming in on social media.
I think it's been an interesting ride over the last 3 months. While numbers have been mixed, as you mentioned, there have been some positive surprises. But I think the bigger driver is the fact that the US economy seems to be doing better than what was expected. The tax cuts which are coming through is leading to expectations that corporate America will up its spending on IT and other investments. And that's the reason why we are seeing a good trend towards IT stocks. The other factor driving is the fact that rupee has weakened, and it looks like the dollar index globally seems to be on a rising path with rising US yields. So that again is adding to the momentum.
There's about a 2-year upward sloping channel that if we extrapolate forward, let's say 12 to 18 months, the Nifty could see about 12,000, right? However, that's contingent on near-term price action remaining above 10,000.
There is still substantial upside overall when you look at India itself, but there needs to be that upside in terms of earnings to justify the valuations that the consumer stocks are standing on currently, which are pretty high.
The oil risk, if oil keeps going and hits $80, which is certainly not inconceivable. It's gone from 70 to 75 in the last few weeks. So, why could it not go further given how tight supply demand is looking? Those are, I think, factors to keep in mind that can cause a bit of a sell-off. We're seeing great growth, and the real question is, we are just coming out of several quarters of disappointments because of GST last and before that demonetization, and so growth is clearly accelerating.
It turned out to be a good session on Friday for us, with the Nifty going home with gains of 0.7%. We had the Bank Nifty, which really outperformed on Friday as well as for the entire week. We have Sudarshan Sukhani joining in now with his view on the technicals for the next week, as well as to answer all of your stock queries. Well, Sudarshan, overall, good session. What do you make of the markets and the technical levels you're watching for next week?
Yeah, good afternoon. See, it was a good session today and a very good April series. I think both have been very enjoyable for traders. A one-sided move, and that move was continued today. The Nifty broke out from an 8-day trading range. Such breakouts normally lead to higher levels. In this case, perhaps 10,800 could be a very reasonable target to be looking at. It's not very far. But traders must be aware that markets can be volatile. So you should have long positions in this market, or even try to initiate them on Monday morning with a proper stop. Your stops are 10,610 for the Nifty and 25,000 for the Nifty Bank. With these levels, so far as the indices are trading above these levels, every day, every breakout is a buying opportunity.
All right. So, Sudarshan, does that apply to the individual constituents of the Nifty Bank? Would you say that the kind of moves we've seen on Axis, SBI, ICICI Bank, are all the stocks looking equally good?
Actually, it's much easier to trade the index, that you also know. But within the index itself, the Nifty Bank, the private sector banks are worth buying into. But the rally in the public sector banks that we saw today could be a flash in the pan. And even if it is not, let's assume that they continue for a day or 2 days. These are bear market relief rallies, the PSU bank rally. So avoid the PSU banks and focus on the private sector banks, whether it's Yes Bank, even after that 13% rally, or ICICI Bank or HDFC Bank, which could now start performing. Yes, the private sector banks are worth buying into.
Okay, what would your picks be, Sudarshan?
Well, you know, we are spoiled for choice today. There are so many mid-caps that have been doing well for the last few days. So it's really, I mean, there could be any number. But we start with Apollo Tyres. At 2:30, I was hearing about MRF and how MRF has been performing. While MRF has been remarkable, other tire companies, primary of them being Apollo, has been doing rather well too. So Apollo Tyres is a buying opportunity. That trade should be taken on Monday, obviously, but you could actually continue with this for a few days. So Apollo Tyres is the first buy. The second is my favorite, Bata India. Bata India is on the verge of a significant breakout on the upside. It's pushing against its resistance levels. It's been an outperformer and it's in a good sector. So the second idea is again to buy, and that's Bata India. The final pick I would suggest is Century Textiles. Century Textiles has been underperforming the market, but it's building a very attractive base. So here we are buying on a dip, anticipating that this dip is coming to an end. It's a very good location to go into if the stock is going to go up. We are literally buying at the lows. So three ideas, all for buying. See, once the market has given us a breakout, we do not go short. So stay on the long side and enjoy the rally.
All right, good going then. Sudarshan, we also have some Twitter questions coming in, so if you could take them up. Venkatachalaman has a question on Tata Global Beverages. He has 1,000 shares of the company bought at a price of 287, and he's a long-term investor. He wants to know whether he should exit, average, or hold on. Now, Tata Global otherwise has been, quite a darling stock of the market. What would your view be, Sudarshan?
You're quite right. It's been a darling stock and will continue to be so. So if he's a long-term investor, generally long-term investors who are invested in blue chip and quality stocks, and Tata Global is a blue chip, it's a quality stock. So if you are invested in good quality stocks, don't even think of exiting. We are in the beginning of a bull market. Why do you want to exit? For Tata Global specifically, do not exit. Stay with it for 3 years and you'll be surprised that it could double itself.
Okay, well, Sudarshan, we have another viewer. Jay has 10 shares of Maruti, which he's bought at 9,090 rupees. He can hold the stock for 6 to 12 months. What's your advice?
Oh, you hold Maruti. I can't, really, I hope in 6 to 12 months, Maruti will be much higher than its cost price. But it's too short a time frame to be very sure of. Much easier is if you have Maruti, you do not sell it, you hold on to it. In 3 years' time, again, it'll outperform.
Okay, all right. Let's move to the next one. Twitter user Money has 140 shares of Sobha Developers. Price is 558 rupees. Wants to know if he should hold or sell out. And what would your immediate targets be on Sobha? I mean, better of the lot has been showing very consistent, sales as far as, the fundamentals are concerned. But on the technicals, Sudarshan?
Well, the immediate target, which means the next few months, 6 to 8 months, is 650. That's a good 100 rupees or 20% higher from where we are now. So he should hold on. Once it comes to 650, perhaps he can evaluate his holdings again. But it should. It's been an outperformer, and I think it will continue to do so.
Okay, well, one more query coming in for you, Sudarshan. Brijesh Mehta has shares of BSE, which he's bought at 900. He hasn't mentioned the quantity, but he can hold for 6 to 8 months. So what would you tell him to do about the stock, considering that it's a bit of a loss that he's sitting on?
Well, I was so pleased. We were talking about stocks that are outperforming, and the only way to go was to hold them. And this one is an exception. I think it should sell out. There's nothing in the stock, nothing at all. So it's nothing. It's very little difference between his cost price and current price. And even if it is, so just get out of it and go into private sector banks, buy Reliance, go and buy pharma companies. Pharma is just beginning a bull market. Why BSE of all the stocks? Just get out.
Okay, fair enough. Thanks, Sudarshan, very much for joining in. You have a good weekend. Thank you for answering all of those questions. Well, with that, it's time for Ekta and me to sign out as well. That's it on Taking Stock this week.